Have you ever wondered why recessions occur? In this vast world of economics, recessions are a recurring phenomenon that can have a profound impact on nations and individuals alike. Imagine it as a sudden brake on the economic engine, slowing down businesses and affecting jobs and incomes. But what exactly is a recession? In simple terms, it's a significant decline in economic activity that lasts more than a few months. It's like the economy catches a cold and everything slows down for a while. In today's discussion, we'll venture into the economic labyrinth to unravel some of the most common reasons behind a recession. We'll dissect the causes and effects from demand and supply-driven recessions to financial crises and policy mistakes. So whether you're a curious mind, a student of economics, or someone who simply wants to understand the world better, this exploration is for you. Stay tuned if you want to better understand the dynamics behind an economic downturn. First up, we have demand-driven recessions. A demand-driven recession is an economic downturn triggered by a decrease in the demand for goods and services. It's like a party where suddenly the music stops and everyone decides to leave at once. In this case, the party is the economy, and the guests are the consumers. Picture this: you're a manufacturer of, let's say, smartphones. You've been producing thousands of phones each month based on the assumption that people will continue to buy them. But out of the blue, consumers start to lose interest. Maybe they're tightening their belts due to uncertainty, or perhaps another product has caught their attention. Whatever the reason, the demand for your smartphones decreases. Now you're left with a warehouse full of smartphones that nobody wants to buy. You've invested a lot in producing these devices, but the expected profits aren't materializing, so you start cutting costs, laying off employees, and scaling back production. This is the beginning of a demand-driven recession. The effects ripple throughout the economy. As you lay off workers, they have less money to spend, which further reduces demand. Other businesses experience the same thing, leading to a cycle of decreased spending and production. The economy starts to contract, and if this trend continues, we find ourselves in a recession. While it may sound simple, demand-driven recessions can be complex and challenging to navigate. Policymakers must strike a delicate balance, stimulating demand without causing inflation to skyrocket. It's like trying to reignite the party without letting it get out of hand. So why do demand-driven recessions matter? Well, they're a reminder that our economy is built on a delicate balance of supply and demand. When that balance is disrupted, the effects can be widespread and profound. In the end, understanding demand-driven recessions can help us make sense of economic trends and perhaps even anticipate future downturns. After all, by knowing the signs, we're better prepared to weather the storm. So, a sudden drop in demand can cause a significant economic slowdown. Next, let's examine supply-driven recessions. A supply-driven recession is a unique creature in the economic wilds. It's a scenario where the world of economics sees a sudden disruption in the supply chain, and the ripple effects can be far-reaching. Now, you might be wondering, what exactly is a supply chain? Well, it's the network of businesses and activities that takes a product from its raw material stage to the final consumer. It's like a relay race where each participant plays a critical role in ensuring the product reaches the finish line, the consumer. Picture this. Imagine an unforeseen event disrupts this relay race. It could be anything from a natural disaster, a trade war, or a global pandemic. This disruption can cause a sudden decrease in the supply of goods and services. When the supply decreases and the demand remains constant, prices tend to rise. This rise in prices can lead to inflation. Inflation, in turn, can cause a decrease in consumer spending. After all, when prices go up, people tend to tighten their belts and spend less, right? This decrease in consumer spending can lead to a decrease in business profits. When businesses start to see their profits drop, they may have to make some tough choices. They may need to lay off employees or cut back on production, which can lead to a vicious cycle of decreased spending and production. And before you know it, we're in the midst of a supply-driven recession. Let's take an example to illustrate this further. Think about the oil crisis in the 70s. The oil-producing countries decided to cut oil production, leading to a sudden decrease in oil supply. The result? Sky-high oil prices, inflation, decreased consumer spending, and ultimately, a severe recession. This goes to show how a sudden disruption in supply, no matter the cause, can have a profound impact on the economy, leading to a recession. It's like a domino effect where one piece falling can trigger a chain of events that bring the entire economy down. A disruption in supply can, therefore, lead to a recession. Another cause of recessions is financial crises. But what do we mean by a financial crisis? In essence, it's a situation where the value of financial institutions or assets drops significantly. They often occur due to unregulated and risky financial practices, such as lending to borrowers who may not be able to repay loans. Let's take a look at a couple of examples. The Great Depression in the 1930s was a financial crisis of epic proportions. Banks failed, stock markets crashed, and people lost their life savings overnight. The economy contracted, leading to widespread unemployment and hardship. The effects of this financial crisis were so severe that they led to a prolonged period of economic downturn, which we now refer to as a recession. Fast forward to the turn of the 21st century, and we saw another financial crisis leading to a recession. This time, it was the subprime mortgage crisis of 2008. Banks and other financial institutions had been lending money to people who couldn't afford to pay back their loans. When these high-risk borrowers started defaulting on their payments, it caused a domino effect. Banks began to fail, the stock market plummeted, and the economy went into a tailspin. The result, the Great Recession, which we're still feeling the effects of today. These financial crises have far-reaching effects on the economy. They erode consumer and business confidence, leading to decreased spending and investment. This, in turn, leads to a decrease in demand for goods and services, further exacerbating the economic downturn. Moreover, in the aftermath of a financial crisis, banks often become more cautious about lending, which can stifle economic growth. So, you see, financial crises aren't just about numbers on a screen or abstract concepts. They have real-world consequences, affecting jobs, businesses, and the quality of life for people around the globe. They're a stark reminder of the interconnectedness of our financial systems and the potential for instability within them. Financial crises, therefore, have the potential to plunge an economy into a recession. Sometimes policy mistakes can lead to a recession. It's like trying to navigate a ship through stormy seas with a faulty compass. You're bound to hit rough waters. Consider fiscal policy, which involves government spending and taxation. If a government spends too much, it could lead to an overheating economy. This means the economy grows too quickly, creating inflation pressure. On the other hand, if a government is too conservative with spending during a downturn, it might not provide the necessary stimulus to pull the economy out of a recession. It's a balancing act, and when the balance is off, it can lead to economic instability. Let's also look at monetary policy, which is the control of money supply and interest rates by central banks. When central banks set interest rates too high, borrowing becomes expensive. This can discourage investment and spending, leading to economic slowdown. Conversely, if interest rates are set too low for too long, it could lead to excessive borrowing and create asset bubbles. When these bubbles burst, they can trigger a recession. A classic example of policy mistake leading to a recession is the US Federal Reserve's decision in the late 1970s and early 80s to drastically increase interest rates to combat inflation. This led to what's known as the Volcker Recession, named after then Fed Chairman Paul Volcker. The high interest rates made borrowing expensive, which led to a significant decrease in spending and investment, triggering a deep recession. However, it's important to remember that policymaking isn't an exact science. Policymakers often have to make difficult decisions based on incomplete information, and sometimes even the best-intentioned policies can have unintended consequences. So, how do we navigate these stormy economic seas? By learning from past mistakes, adapting to changing conditions, and employing sound economic principles. It's all about finding the right balance. Poor policy decisions can indeed have a detrimental impact on the economy, but with the right adjustments we can steer the ship back on course, even in the most turbulent of times. So those are some of the most common causes of a recession. We've unpacked how demand-driven recessions occur when consumption significantly drops, and supply-driven recessions arise when production costs escalate, inhibiting supply. We've also delved into the role of financial crises, often spurred by risky investments and lending practices, in triggering economic downturns. Lastly, we've highlighted policy mistakes where ill-judged governmental decisions can inadvertently send an economy spiraling. These factors intertwine in complex ways, shaping the economic landscape we navigate daily. The better we understand these dynamics, the more equipped we are to make informed decisions, whether as individuals or governments. We can better prepare for economic downturns and even contribute to mitigating their effects. Knowledge is power, and in this case, it's the power to navigate economic uncertainty with greater confidence and resilience. What do you think about the reasons we discussed today? Don't forget to like, comment, and subscribe to our channel for more insightful videos like this one.